just to set the stage and kind of the backdrop, there's a bunch of trends that have kind of gone on in the market, particularly over the last decade or so. And it seems like in your paper, this liquidity cascades paper, there's really three main things that have changed in the market that you tried to tie together. The first is that the Federal Reserve policy and the unprecedented Federal Reserve action since '08. The second is the rise of passive investing, which, as we know, has become a lot more popular. And the third is this increased use of options and derivatives. And so you sort of bring this all together in your paper with that initial figure. I think it's figure one, and we'll put a link. We'll show this in the podcast, but you call it the market incentive loop. And so I was wondering if you could just kind of at a high level start working your way through that, because that'll help us kind of peel back the onion and get into these things in a little bit more detail.
Absolutely. And maybe to set a little context at the table a bit, a lot of this research was inspired by March 2020, and a lot of the questions I was getting from advisor clients of mine who were simply saying markets continue to just seem to be so weird, so disconnected from reality. Is there something there? And so for me, when I being a quant, there wasn't evidence before that I could really identify that markets were truly statistically different, because a lot of what quants are looking for, right, is that depth of evidence occurring over time to try to find that difference. And when I started to sort of survey a lot of the narratives that were out there, it tended to be more of a breadth of evidence, a lot of coincidental information occurring at the same time. And it's a very different way of viewing the world. But really, to your point, there were three main narratives. It was this idea of a, depending on the language you want to use, a Fed supported or Fed manipulated market, that the Fed had ultimately moved, and central banks around the world had ultimately moved from a referee to a key player within the market, and their actions are actually having knock-on effects in the way investors are behaving. The second, to your point, is about the rise of passive, which has both sort of macro and micro impacts, depending on how we want to go into it. And that one, really, I got to give a ton of credit to Mike Green at Logica, who has really been on the vanguard, no pun intended there, of that sort of argument about passive. And then again, this idea of the role of derivatives hedging, structured products, the growth of the options market. And again, guys like Chris Cole, Vanir Bansali, Ben Eifert, Jem Karzan have really been, advocating these ideas. So I really want to stress these are not core new narratives that I've developed. These are just things that we're all out there. And so what was really interesting to me about doing this research is that a lot of times the parties who are proponents of one particular narrative had very high conviction in that idea. And again, a lot of the evidence for those ideas was very circumstantial. What was really important to me as I started to piece this all together was that even if our conviction in any of these individual ideas isn't particularly strong, all of these ideas in conjunction seem to put the same pressure on the market. So the way the loop sort of worked, to go back to your original question after my 3-mile tangent there, is that it doesn't really have a beginning or an end. It arguably sort of gets accelerated when the Fed steps into the market, and through their policy, as well as just their general narrative, serves to explicitly suppress interest rates as well as suppress volatility, again, through that sort of narrative economics avenue. By suppressing interest rates, they have the implied action is that investors have to move up the risk curve to hit their returns. Then the question becomes, well, how do they ultimately make that investment decision? Well, in a market where the risk-free rate is lowered, things like fees all of a sudden become more important. And so there's going to potentially be a move to passive for regulatory and fee pressures and some performance chasing that's going on. And that move to passive can ultimately create potential distortions, which we can get into. They also are going to start piling into what I would call volatility contingent trades. So these are going to be trades where they're trying to sort of have their cake and eat it too, where they want to buy equities, but do so in a risk managed way. All of this sort of keeps pushing investors into a corner, sort of the left tail, that ultimately isn't a problem until there's an exogenous shock, something like the Corona crisis, where suddenly there's a large force to unwind. At the same time, a lot of liquidity disappears from the market because high-frequency traders become capital constrained. While that occurs, all of these volatility contingent strategies become liquidity takers. And when there's no liquidity there, that helps drive up volatility. That helps put market pressure in a negative direction. And unless the Fed steps in or there's some other sort of release valve, it just sort of becomes a pro-cyclical pain point. Ultimately, the Fed did step in March 2020. in a very big way, and arguably has sort of kicked the cycle off anew into the next couple of years. So that is sort of the general idea, that none of these ideas are independent. They all sort of work in concert to create a more unstable market than we've really seen in the past.